Alright, gang, it's your boy Nature, aka Nature. Alright, so gang, this is the last session that we have to go over. It's the graduation session, so congratulations that you made it this far. So final words of wisdom before you venture off into the challenging world of trading Forex, okay? The most common trading mistakes new to traders new traders make is making mistakes as part of the learning process. But when it comes to trading, here are the most common mistakes that beginners traders make. Okay, so the 5 daily O's of trading. What traders do to guarantee their own failure. Okay, so we're going to go over, the most common mistakes that new beginner traders make. So the 5 daily O's of trading. What traders do to guarantee their own failure. Did you know that the 5 deadliest factors that cause traders to fail are self-inflicted? Many traders self-sabotage their own trading and may not be even aware that they're doing it. When their account goes to zero, they have nobody to blame but themselves. Okay, this is your trading account going to zero. While it might be too late for these traders, fortunately, it's not too late for you. We want to make sure that you don't suffer from the same buying spots and can hopefully avoid sharing the same fate of a blown account. To make it easier, remember we call these negative factors the O's of trading, and there are 5 of them. Okay, so these are the 5 O's. The 5 O's. Okay, where are the 5 O's? So overconfidence, overtrading, overleveraging, overexposure, and overriding your stop losses. Let's take a look at each of the O's more closely. So we got overconfidence. Overconfidence is simply the feeling that you can handle anything. Overconfidence is characterized by the inflated belief that one's own trading skills. So it's too easy. Confidence is critical in becoming a successful trader. When you're confident, you're more likely to take risks or look for opportunities. However, and one thing to believe that your trades can potentially be profitable, but it's another thing to believe that you can think that you know everything about the market and that there's no way for you to ever lose because all you do is win. You are not DJ Khaled. While confidence is necessary, too much confidence can have a negative consequences. Okay, so the phenomenon is known as overconfidence effect. Okay, so overconfidence effect is a cognitive bias in which someone believes subjectively that his or her judgment is better or more reliable than it objectively is. Basically, when your confidence is high, your opportunity of your success higher than what is impartial and rational person who is not your mom who would think about you given the same set of facts. Psychologists observe overconfidence in 3 distinct forms: overestimated, over precision, and over placement. So overestimate is the tendency to overestimate one's performance. Over precision is the excessive confidence that one knows the truth, and over placement is the judgment of your performance compared to another. Said differently, overconfident folks believe that they're better than most and overestimate the precision of their knowledge and the level of their abilities. For example, if you ask a bunch of random people to rate their own driving abilities, you'll find that most people consider themselves to be above average drivers. If everyone is above average drivers, where are the average drivers? To minimize the effect of overconfidence effect, you must take time to truly understand yourself and what you are capable of achieving. You must be aware of your limitations and what opportunities are not worth pursuing. Most importantly, you must always consider the possibilities that you are wrong, to listen to new evidence, and to know when to change your mind. You may have the confidence to trade, but this must be balanced with intellectual humility. Okay, so some intellectual humility is needed. Okay, so overconfidence, overtrading, including revenge trading. So overtrading is when you are trading too frequently, taking extremely large trades and or taking uncalculated risks. Successfully, traders are extremely patient. Quality setups takes time to materialize, so they remain patient and wait for confirmation. Okay, so successful traders are extremely patient. It doesn't matter if the setup takes 2 hours or 2 weeks to take shape. What matters is protecting your capital so that you will wait until the odds are more in your favor before entering. You will know if you are overtrading. If you close the trade for a loss and deep down you feel like you shouldn't have taken that trade, then you are guilty of overtrading. Okay, so what the fuck was I thinking? For example, if you're supposed to trade from the daily chart, do you find yourself still looking at the lower time frame, like the 5-minute chart, discovering better trades there? Do you find yourself, you're supposed to be trading from the daily chart, and do you find yourself looking at the lower time frames, like the 5-minute chart, and discovering better trades there? Do you find yourself spending hours staring at your chart and trying to force a trade with a good enough setup? Spending too much time staring at charts tends to cause overtrading because you become prone to falling into a trance, looking at so much price action and indicators that magically setups will just start appearing, which actually are just migraines. Okay, so it's important that you don't overtrade. Okay, so revenge trading, letting your emotions get to you regarding your trading performance is dangerous. When it comes to trading, the head, not the heart, should be in charge. Okay, so you trade with your head and not with your heart. Okay, so when you suffer a large loss or a series of losses within a short span of time, you must be tempted to revenge trade. Okay, you will be tempted to revenge trade. You want to get back at the market. Revenge trading is when you jump back into a new trade right after taking a loss because you believe that you can quickly flip your loss back into a profit. The new trades will quickly recover the loss I just made. When you start thinking like this, you're not in a state of mind of objectivity and of thinking objective anymore, because you become more prone to making even more trading mistakes, which results in you losing even more money. How do you avoid revenge trading? Be fully present and fully focused while trading. Make sure, number two, make sure you're in a good state of mind and that you're not currently filled with negative emotions such as anxiety, empathy, fear, greed, and impatience. Having a trading plan is number three. Having a trading plan to stick to it. Always trade in methodical manners. There is no place for random improvisations. Okay, when you enter or in a trade. Okay, do not just trade just random without having a trading plan. Okay, and just enter a trade without having a trading plan. Okay, you want to be as successful as you want to be successful as a trader. You must think long term. Okay, so you must have a trading plan and you must think long term about your trades. Okay, don't stress over one loss or even losing a couple days in a row. Stay focused on your trading performance over the coming months and years. It's easy to think that the more that you trade, the more money you'll make. But that's the opposite is true. Trading is a game of patience. Traders who wait for quality setups and set up their own hands and sit on their own hands and are between one and are between are the ones who will end up profitable in the long run. So focus on the process, not on the profit. Okay, so don't put a trade on. Don't put a trade on. Don't put a trade on. Make sure you have a good trading, a good trading plan so you can last through the trades. Okay, it's okay to lose one or two trades, but you want to be trading for years and months to become. So you want to be patient when it comes to your trading. So another thing is over leveraging. Okay, so that's the third L in forex trading. Leverage means that with a small amount of capital in your account, you can open and control a much larger trading position. For example, with 1,000, your broker might allow you to open 100,000 position. This is 100-to-1 leverage. The advantage of using the leverage, you can magnify gains with a limited amount of capital. The disadvantage of leverage is that you can also magnify your losses and quickly blow your account. Why is my account balance negative? When trading with excessive leverage, a small price swing can wipe out your entire account balance. Okay, the greater the leverage level is that you use, the greater the swing in your account equity is. Okay, so in most cases, you end up with a margin call. When your account equity is jumping around due to highly leveraged positions, good luck keeping your emotions in check and not letting it affect your thinking. Okay, so if you up the leverage, then even a small price can swing out your entire account balance. So the greater the leverage level you use is, the greater the swing in your account equity is. In most cases, you'll end up with a margin call. So you want to think about that. And when your account equity is jumping around due to highly leveraged positions, good luck keeping your emotions in check and not letting it affect your thinking. Nobody wants to be around you when this happens. I'm mad because the value of my trading account is so volatile. When trading with low or no leverage, you will have trading room to breathe. It gives you trading room to breathe, and it protects your trading account when you trade with a low leverage, okay, or low lot size. Okay, it gives you more trading room to breathe, and you can protect your trading capital in the long run. Okay, so we want to think long term about this. For example, you'll be able to accumulate wider stop losses while keeping your risk limited. The higher your leverage, the greater your risk on each trade. likely resulting in irrational decision making. Okay, so the higher your leverage, the greater your risk on each trade. The higher you leverage your trades in your position size, it's more likely resulting in irrational decision making. Okay, so Forex is not a get rich scheme overnight. You don't get rich overnight doing Forex. Okay, it takes patience and it takes time. So knowing the links between leverage and your account equity is critical since it determines your true leverage. Here's a study that was done by popular Forex brokers showing a percentage of profitable traders by average true leverage. Okay, so you can see the more that they had their leverage, it went from 5 to 10 to 25. As you can see, the profitable declined substantially as true leverage increased. Okay, so 40% of traders using true leverage of 5 to 1 or lower were profitable compared to only 17% of traders using 25 and 1 leverage or higher. More professional traders trade very low true leverages and rarely go above 10 to 1. That's how they stay in the game. So regardless of the leverage amount that your broker offers, you can eliminate these lower leverage levels by simply depositing more money in your account and managing your risk properly by using proper position sizings. Okay, so use true leverage of 10 to 1 or lower. Only risk 10% or less of your account balance at any given time. Never let the value of your trades open exceed 10 times your account equity. So, I realized that my blood pressure stayed low when I kept my leverage low. Okay, so to calculate your true leverage of a single trade, you want to divide your trade size by your account equity. For example, if you open an account with 5,000 in equity and a 10 to 1 leverage would mean that opening position is no longer than 50,000 or 5 minis or 50 micro lots at a time. The lower the leverage, the safer. For example, 2 to 1 leverage would mean opening position no longer than 10,000 or 10 micro lots at a time. If you care about longevity, which everything is longevity as a trader, the less leverage you use, the better. Okay, so the less leverage you use, the better, and the more longevity you'll have as a trader. So having access to high leverage doesn't mean you need to use it. Okay, just because you have access to high leverage doesn't mean you need to use it. Okay, it's better to use less leverage, so you can have longevity as a trader. I shouldn't have to use so much leverage. Now we're homeless. Okay, using too much leverage can blow your whole account, and that was just your whole paycheck, and now you're homeless and you're stressed out. Okay, so when you first open your live account, try to start off trading with zero leverage or small leverage. For example, if you have 5,000 in your trading account, don't open any position larger than 5,000 or 5 micro lots at a time. With experience, you'll learn when is the best time to use leverage and how much leverage to apply to help you achieve your financial goals. When using the amount of leverage, trade with caution, okay, should be your priority. Okay, with using any amount of leverage, trading with caution should be your priority. Okay, so excessive leverage makes profitability significantly less likely. Okay, and you're less likely to be successful when you are excessive on your leverage. Okay, that's another thing. Do not over leverage. Okay, and the last O is overexposure. When you have multiple positions open in your trading account and each position consists of a different currency pair, always make sure you're aware of your risk exposure. Okay, because you can open more positions. Okay, so both of my trades got stopped out at the same time. For example, on most occasions, trading Aussie USD and New Zealand USD is essentially like having two identical trades open because they usually move in the same manner. Okay, so that's another thing. Trades move in the same manner. Most currency pairs all move the same. So if it's going down on one currency pair, most likely it's going to be going down on the next currency pair. So that's how currency pairs work. They're identical, with their trades, and they openly move and usually move in the same manner. Even if there are two valid trade setups in both pairs, you may not want to take both though. Okay, instead, it might make more sense to pick one out of the two setups. Okay, and just focus on one trade and one currency pair at a time. Okay, until you build more capital in your account. You might believe that you're spreading or dividing your risk by trading in different pairs, but many pairs tend to move in the same direction. Okay, so that's another thing. Pairs tend to move in the same direction. Okay, so instead of reducing your risk, you are magnifying your risk. Unknowingly, you are actually exposing yourself to more risk. This is known as overexposure. Unless you plan on trading just one pair at a time, it is critical that you understand how different currency pairs move in relation to each other. Okay, you need to understand that the concept of currency correlations. Okay, so this is currency correlations. Okay, so currency correlations measure how two currency pairs move in the same slash opposite or totally random direction over some period of time. So two currency pairs can move in the same direction or the opposite direction or just in totally random directions over the same period of time. Okay, so usually currency pairs can move in the same direction. Okay, but they also move in opposite and totally random directions over some period of time. You need to be familiar with how currency correction can actually affect your risk. You're exposing your trading account too. If you don't know what the heck you're doing when trading multiple pairs simultaneously in your trading account, don't be surprised if your trading account balance goes poof and goes to zero. Okay, so and the last one is overriding stops. Stop losses are pending orders you can enter that effectively close out your trading position when losers hit a predetermined price. It might be psychologically difficult for you to acknowledge being wrong, but swallow your pride and keep you in it. But if you swallow your pride, it will keep you in the game longer. Do you have the mental toughness and self-control to stick to the stops? Okay, so my stop loss is about to get hit. I set it too tight. Price is about to reverse soon. I'll just remove it. In the heat of the battle, what often separates the long-term winners from the losers is whether or not they can objectively follow these predetermined plans. Traders, especially the most inexperienced ones, often question themselves and lose that objectivity when that pain of losing kicks in. Negative thoughts appear such as I'm already down a lot, might as well hold on. Maybe the market will turn right back around. Wrong. If the market has reached your stop, your reason for the trade is no longer valid and it's time to close that trade and get back in the opposite direction and at least make some of your money back. Do not widen your stop, okay? Do not stay in that trade, okay? If the market reaches your stop or it's going in the opposite direction and it's going and you need to get out that trade, okay? Even worse, you do not want to override your trades or override your stops, and just let it ride, okay? This is where I remove my stop loss and I blew my account, okay? You will blow your account that way if you just let your trades override and you just let it ride and think that the market going to go back up. The market can do whatever it wants, okay? So increasing your stop only and increasing your risk and your stops, when the market goes against you, can risk and, can decrease your amount you will lose, okay? So increasing your stops only increase your risk and the amount you will lose. Okay, if the market hits your plan and stops, then your trade is done. Okay, if the market hits your plan, stop, and then your trade is done. Okay, it hits your plan, it hits your target. Okay, you stay on your trading strategy and you stick to your trading strategy and you exit according to your strategy exit. Okay, so take the hit and move on to the next opportunity, okay? So take the money and just move on to the next opportunity, okay? It's going to be more trades. You're going to be doing it for a long time, okay? So you're going to be in this game for a long time. So widening your stops is basically like not having a stop at all, okay? Or just letting your trades just ride. It's like not, it's not having common sense, and it doesn't make any sense to do it, okay? So stop losses help you limit your losses and help you move on. Okay, so these are the 5 O's of trading: overconfidence, overtrading, overleveraging, overexposure, and overriding your stop losses. All right, so gang, it's your boy Nature, aka Nature. In our next lesson, our next video, we'll go over how to lose all your money in trading account in 10 days or less. All right, so it's your boy Nature, aka Nature, gang.